Mortgage Meltdown. How did the Mortgage Meltdown occur, and why is this a mystery to so many people? One man's opinion, the short version. Intro. Watching the news almost every day, I'm intrigued by the mystery and total lack of understanding as to how the subprime mortgage meltdown occurred. The date's 4/25/2010. Let's make it simple. I will attempt, in my opinion, to explain how it happened so that you guys and gals on Fox, Happy Hour at CBS, NBC, ABC, CNBC, CNN, etc. can talk about it. I have to do it in 10 minutes, so it'll fit on YouTube. So, who am I? From 1987 to 1994, I was an investment banker working for several firms, the last of which was Westcap Securities in Houston, Texas. Hang on, this is going to go fast. What did we do? We sold mortgage-backed securities, or MBS, and collateralized mortgage obligations, or CMOs. Basically, smart guys took cash flows from either 15 or 30-year maturing mortgage backs and sliced and diced them so that they had different maturities and interest rates that could be sold to institutions and called them CMOs and later CDOs. Mortgage-backed securities, CMOs, CDOs, what the? This is supposed to be simple, man. CMO, CDO, MBS, what? CMO, collateralized mortgage obligation, good conforming mortgage-backed securities grouped together and carved into tranches. Collateralized debt obligation, CDO, shitty mortgage-backed securities grouped together and carved into tranches. Tranches, what the? What does a bond investor want? First, they want their money back or the principal they loaned you. Will Rogers once said, I'm not so worried about getting back the interest on my money, just give me my money back. Second, the interest earned over time, the money was loaned. Let's make it simple. What's a mortgage? You want to buy a home. You don't have any money to pay cash for this home. You borrow money from someone to buy the home. The document you sign promising to pay back the loan is a mortgage. The borrower. Damn, I regress. When I was selling mortgage-backed securities, the loans had to be conforming in order for the companies purchasing the mortgages to be allowed to purchase them. Conforming loans. Conforming simply meant that when a person bought a home, they had to be qualified to buy it and were required to prove it. The term conforming is also tied to something called liquidity. Liquidity. In order for there to be enough money to loan people to buy their home, Freddie and Fannie buy conforming loans from companies and banks that loan you money so that you can buy your home. Conforming loans, what? Fannie, Freddie buy loans from banks if they conform to certain underwriting standards. This simply put means if the loans meet certain standards, they don't suck, they'll buy mortgages from the banks to replenish their money. Now, the bank has more money to loan to more people who want to buy homes. Voila, liquidity. Enter Congress, secret. It's simply not fair that people just cannot afford to buy a home. What's this conformity thing? Not so secret banking committee meeting take place. Thanks, Barney Fife. Shit, it's not fair to have to come up with 20% of the value of a home as a down payment. My constituents just don't have that kind of money. And damn it, it's just too intrusive to have to prove how much income someone has. Besides, the housing market's never done anything but go up. The value of the home should be good enough to back the mortgage. What's this thing? Oh, no more adjustable rate mortgages, no more interest-only loans. Wow. Make it so, number one. Freddie and Fannie walk in, hand and scream, but we're private companies and these loans are not conforming to our standards. We'll go broke. Congress says, hell you do. We know we love you, and we're not going to let anything happen to you. Shucks, you're quasi-government agencies anyway. Everyone knows we'll take care of you. Besides, look at all the people we're helping out get the American dream. Slap on the back, pat on the tush, hee hee ha ha. Okie dokie then. Freddie and Fannie directive. Buy everything, boys and girls. Anything's fair game. If the loan is issued by the bank, it's conforming. Screw all those old rules. Everyone deserves a piece of the American dream. What? Let's make it simple. Say Freddie bought 1,000 mortgages. Each individual loan is for $100,000 from Joe's bank. They would have $100 million in mortgage-backed securities they could sell to, let's say, Goldman Focks US. Goldman Focks US? Who the hell is that? Goldman Focks US is a fictitious investment banking firm from the United States who's in the business of making money. How do they make money? Well, let's see. Goldman Focks US buys 1,000 blocks of mortgage-backed securities, which came from 1,000 banks who loaned $100,000 to people who want to buy homes. Are you following me? That's $1 billion. Yeah, and that's a small deal. Goldman Focks US buys $1 billion worth of mortgage-backed securities. What are MBS again? Mortgage-backed securities are created by Fannie and Freddie, and now they're guaranteed to pay back the principal and interest on $1 billion worth of mortgages that owned by moms and pops across the country. Mom and Pop pay their mortgages back each month every time they make their house payments. Recap. Mom and Pop saw a house they liked. The house was valued at $400,000. It was so much nicer than the apartment they were living in, and they never had a home before, and damn it, it's a nice home, and man, they deserve it. Jimmy Jack John appraised the home at $400,000, and Mom and Pop applied for a no-doc loan. This meant they did not even have to prove they even have a job. Shit, this is a sweet deal. No down payment, and what? A teaser rate arm to boot? What the hell's a teaser rate arm? Hell, Mom and Pop, we like you so much. Teaser rate arm. That's right, Mom and Pop. We like you so much, and the market's so sweet. All you have to do is pay 3% interest for 2 years, at which point it will adjust 700 basis points above the 1-month LIBOR, which is adjusted monthly. Hell, LIBOR is only at 1.2%. Just sign here. Your payments are only $798 a month. Hell, you're already paying $650 for that apartment, man. Get you some equity. What the hell? Okay, let's make it simple for all you investors. We here at Goldman Focks US are guaranteed to receive principal and interest for 30 years on the house payments people are making on their homes by Fannie Mae and Freddie Mac, right? Who cares if Mom and Pop can't make the payments? If you read the fine print, after the first 2 years, those poor saps, the homeowners, are going to have to pay 700 basis points over the 1-month LIBOR interest rate. That's 7%, man. LIBOR's London Interbank Offered Rate, or monthly rate similar to the prime rate. If LIBOR goes to 3%, we'll be getting 10. Goldman Focks US. Okay, boys, we've been carving up these mortgage-backed pools into CMOs for years, and we've made a lot of money selling them to our clients. That's what we do. City and state governments, investment pools, banks, savings and loans, hedge funds, they're guaranteed by Fannie and Freddie to timely payment of principal and interest to our investors. Life is sweet. We can take 50 or 30-year mortgage backs, and since we're so smart, we can take the principal and interest payments coming in for the next 30 years and make other securities out of them. We can take all the interest and principal coming in and direct it to make any maturity we want. But wait, these are kind of shitty loans, so let's call them CDOs instead of CMOs. Hell, they buy everything we make. We're Goldman Focks US. We make money. That's what we do. I can't invest for 30 years. I didn't say you had to. We've got this thing called a CMO. No, shit, sorry. This one's called a CDO. You remember, we made tranches on CMOs that fit your maturity requirements, right? We can do that with CDOs too. What you got, man? Well, like I was saying, dude, it's like we simply take the rocket scientists we hire here. They know we're guaranteed by Freddie and Fannie. We're told in secret that the government would back them no matter what to receive principal and interest on the mortgage-backed securities we own, right? You got it? You want a 2-year average life on your bonds, right? Right. Okay, like I said, our rocket scientists are sure they can pay you, say, 3% on a 2-year average life bond, and you know the Treasury bond is trading at 1.5%. That's a 150 basis point pickup in yield over the Treasury for the same dollars invested. How many you want? We'll take them all. Gimme, all you got. With the backing of the U.S. government, everyone bought all the bonds that were issued by Goldman Focks US. Why not? They paid a higher rate of interest over the same time frame as Treasury bonds, and they were guaranteed by the U.S. government. Get to the point, man. Okay, back to the mortgage meltdown. Goldman Focks US has literally billions of dollars of the CDOs they've created. They have average lives, maturities of 1 year, 2 years, 5 years, 10 years, 25 years, floaters, inverse floaters, IOs, POs, and all sorts of fancy derivatives. Another word, derivative. Relax. All a derivative is something that will protect you in the event that something else happens. You got it? The mortgage meltdown, man. Okay, one day, Goldman Focks US employee in a small room overlooking Manhattan, mind you, one of these rocket scientists looks up and says, "Holy shit, these mortgages are crap. I wish I would have looked closer at these things several years ago. Shit, these people didn't even have to prove they could make the payments on these homes. I know that they're guaranteed by Freddie and Fannie, but hell, no one has that kind of money. Shit. I hope the U.S. government stands behind them because this shit's going to hit the fan. But wait, who's that guy in the office down the hall? He called me last week, something about a credit default swap. Credit default swaps. Ring, ring. Hey, dude, these mortgages we have and the CDOs we issued are shit. All probability models say that they'll blow up. We're really screwed. People are starting to ask questions, dude. And what about the SEC? Don't worry about the SEC, man. I sent the SEC a mass email with a link to a great porn site. They're all busy, and I've been working on a deal with this guy at a huge insurance company called American Genocide that will insure anything. They have so much shit insured that the whole monetary system would fail if they went down. There's no way the government would let them go down. All you have to do is get them to issue the insurance on the CDOs guaranteeing any default that may or may not happen, and we're home free. And the insurance is cheap, man. Can you say AAA? Please, man, I'm begging. What happened? Anyone could buy any home they wanted. Congress thought everyone should be allowed to own anything and relax the requirements to do so. It did not matter what the cost was. No documentation was required. The home was all the collateral you needed. Job? Who needs a stinking job, man? The market crashed. The value of the homes dropped. The arms adjusted up, and the people simply could not make the payments any longer, so they stopped. Nearly everyone was too big to fail, though, so the guarantees kicked in. The U.S. government bailed out American Genocide, AG, on the default swaps because they were too big to fail. Shit, everyone was assured by AG. Some of the investment banks did not have ex-CEOs working for the government, so they were allowed to fail. But AG paid Goldman Focks US on the default swaps first since they were bailed out. So Goldman Focks US made money when they sold the CDOs, and they made money when the default swaps paid off. That's what they do. Understand now? The end.